All right, the credit crisis may be over, but risks remain for the U.S. financial system. That's the conclusion of a report today from the IMF, which conducted its own bank stress tests for us. It found that U.S. financial system remains fragile and may need as much as $76 billion in additional capital. Joining us now is Christopher Towe, the Deputy Director of Monetary and Capital Markets, who directed the fund's stress tests. And it's a pleasure to have you on, Christopher. Thanks for joining us. Let me ask you about this. It's surprising because that's about the amount of capital that U.S. banks raised after the first stress tests. How did you come to these conclusions?
Well, actually, Matt, the U.S. banks did raise much more than that. They raised well over $200 billion. I think it's important to recognize that our stress testing was based on the assumption of an adverse scenario. Our baseline scenario suggests a much smaller amount of capital needs, closer to the range of $40 billion, something that we consider quite manageable.
What is the most adverse scenario? Because a lot of people complain, for example, that the European stress tests were not stressful enough.
Well, in our case, our adverse scenario assumed essentially a double-dip recession. We assumed effectively that growth would slow below 1% next year, which would be roughly consistent with 2 quarters of negative growth, and then a very modest recovery thereafter. But again, I would just emphasize that that's an adverse scenario, but not our baseline, which is for much more comfortable and reasonable growth.
So your baseline scenario calls for raising capital of about $40 billion across the system. We have seen record debt sales, record corporate debt sales this July. Do you expect it to be just as easy for banks to raise capital this time as it was during the first wave? Are they doing it already?
Well, our estimates are that there's a very significant amount of maturing corporate debt coming due in the next year or so. So it's not surprising that corporates are trying to raise money. Interest rates are low. It's an opportune time to take advantage of low interest rates. The issue going forward, particularly for the banking sector, is a very large, what we call a wall of maturities coming due. And that's where the pressures we see especially salient, especially in the commercial real estate sector.
Let me ask you, you also recommend in your report that regulators be or remain vigilant, especially vigilant here, to guard against risks and weak spots. What exactly do you want regulators to be looking at so closely?
Well, that's a good question. I mean, I think we are very impressed by the Dodd-Frank Act and the regulatory reforms that it introduces. Our real concern is that bold steps were not taken to simplify the regulatory environment. There's still a very large number of regulatory agencies involved. So the real challenge will be for this new Financial Stability Oversight Council to exercise a degree of oversight over the regulators and make sure that they coordinate, cooperate, and share the information needed to exercise proper oversight.
All right. Hey, Christopher, thank you so much for joining us. We had, I know, some technical difficulties getting to you here, so I really appreciate you sticking with us. Christopher Towe there, Deputy Director of Monetary and Capital Markets at the IMF.